Welcome to the market opening bell on Thursday, August 21st, your 10-minute guide to the stock market. On Wednesday, Hong Kong stocks experienced an initial decline followed by a recovery. The Hang Seng Index opened 154 points lower, dropping as much as 234 points early in the session to a low of 24,887 before losses narrowed. By the afternoon, it rose alongside mainland Chinese markets, briefly gaining 88 points to reach 25,210 and ultimately closed up 43 points or 0.2% at 25,165. The H-share index edged up 7 points to 9,013 while the Hang Seng Tech Index dipped slightly by less than 1 point to 5,541. Total market turnover reached 285.2 billion Hong Kong dollars. Southbound funds recorded a net sell-off of 14.682 billion Hong Kong dollars in Hong Kong stocks, with notable net purchases in Tencent, 969 million. PopMart 343 million, Oriental Selection 302 million, and Xiaomi 185 million, while significant net sales included Tracker Fund 10.32 billion, Hang Seng China Enterprises ETF 5.727 billion, CSOP Hang Seng Tech ETF 2.712 billion, Alibaba 527 million, and Xpeng 384 million. Data indicates that southbound funds have consistently net bought Tencent for 4 days, totaling 3.7 billion. From a technical perspective, the Hang Seng Index touched the low of 24,887, filling the rising gap from the previous Wednesday between 25,016 and 25,176. It closed at 25,166, reclaiming the 25,000 level and rising above the 20-day moving average of 25,141. A brick above the 10-day moving average at 25,168 could pave the way for a test of 25,450. Mainland Chinese markets opened low but later climbed. The Shanghai Composite Index hit the low of 3,704 before closing at 3,766, up 39 points or 1%, marking a 10-year high. The Shenzhen Component Index fell to 11,677 but closed at 11,926, up 105 points or 0.9%. Combined turnover for Shanghai and Shenzhen markets was 2.4082 trillion yuan, down 180 billion yuan from the previous day. The renminbi central parity rate declined for 2 consecutive days, reaching a one-week low of 7.1384 against the US dollar, down 25 pips from the prior trading day, the lowest since August 12. The People's Bank of China maintained the loan prime rate LPR unchanged for the third consecutive month, with the 1-year LPR at 3% and the 5-year plus LPR at 3.5%. In corporate earnings, Hong Kong EX reported a 33% year-on-year increase in first-half revenue and other income to 14.076 billion Hong Kong dollars, driven by a 34% rise in core business revenue from record high half-yearly trading volumes in spot and stock options markets, high custody fees, and increased investment income from larger margin funds. Its EBITDA margin rose to 79%, up 6 percentage points, with profit attributable to shareholders climbing 39% to $8.519 billion. Basic earnings per share was $6.74, and an interim dividend of $6 was declared, up 37.6% year-on-year. The average daily securities market turnover surged 118% to 240.2 billion Hong Kong dollars, while futures and options daily average contracts grew 11% to over 1.7 million. Hong Kong's ETF market saw average daily turnover soared 184% to $33.8 billion. Both Shanghai Hong Kong and Shenzhen Hong Kong Stock Connect recorded record high half-yearly volumes, and Bond Connect northbound average daily turnover rose 3% year-on-year, also hitting a record. By June 30, new listing applications in process doubled to 207 from 84 at year-end 2024. In the second half of 2025, Hong Kong EX plans to enhance market competitiveness by shortening spot market settlement cycles, expanding paperless listing mechanisms, optimizing IPO pricing rules, and lowering the minimum trading spread for securities in the first phase. Laopu Gold reported a 251% year-on-year surge in first-half revenue to 12.354 billion yuan, with gross profit rising 223.4% to 4.705 billion yuan, and net profit soaring 285.8% to 2.268 billion yuan, yielding an earning per share of 13.38 yuan. An interim dividend of 9.59 yuan was announced compared to none last year, with the proposed policy of biannual dividends at a 50% payout ratio. The company adjusted prices 2 to 3 times annually, but only once in February 2025, resulting in a slight gross margin decline to 38.1% due to rapidly rising gold prices post-adjustment. However, scale effects from explosive growth lifted the non-IFRS adjusted net profit margin to 19% from 17.1% the previous year. By June 30, Laopu Gold operated 41 self-owned stores across 16 cities, entered 3 new commercial centers, expanded 2 existing stores, and opened its first overseas store at Singapore's Marina Bay Sands on June 21st. Baidu's second quarter revenue fell 3.6% year-on-year to 32.713 billion yuan, meeting expectations, while non-GAAP net profit dropped 35.2% to 4.795 billion yuan, also as expected. Its Baidu app had 735 million monthly active users in June, up 5% year-on-year. In Q2, its autonomous driving service, Apollo Go, delivered over 2.2 million fully driverless orders, up 148% year-on-year, with cumulative orders exceeding 14 million by August. Henderson Land saw first-half revenue decline 18.8% to 9.552 billion Hong Kong dollars, with net profit down 8.4% to 2.908 billion dollars, and earnings per share at 0.6 dollars. The interim dividend remained at 0.5 dollars. Fair value loss on investment properties was 140 million dollars, down 93.82% from 2.267 billion dollars last year. Underlying profit fell 44% to 3.048 billion dollars, with underlying earnings per share at 0.63 dollars compared to 1.12 dollars last year. Net debt was 67.415 billion Hong Kong dollars as of June 30, slightly down from 67.989 billion dollars at year-end 2024, with a gearing ratio of 21.1%. Shareholder loans total 73.923 billion dollars. Hong Kong and China Gas reported a marginal 0.1% rise in first-half revenue to 275.14 billion dollars, with net profit down 2.5% to 29.64 billion and earnings per share at 0.159 dollars. The interim dividend was unchanged at 0.12 dollars. Excluding borrowing exchange losses, core business profit rose 4%. By June 30, customer accounts reached about 2.04 million, up over 5,000 from year-end 2024. The group expects further gas sales growth by actively participating in the Northern Metropolis development. Hong Kong and China Gas reported a marginal 0.1% rise in first-half revenue to 27.51 billion Hong Kong dollars, with net profit down 2.5% to 2.965 billion dollars, and earnings per share at 0.159 dollars. The interim dividend was unchanged at 0.12 dollars. Excluding borrowing exchange losses, core business profit rose 4%. By June 30, customer accounts reached about 2.04 million, up over 5,000 from year-end 2024. The group expects further gas sales growth by actively participating in the Northern Metropolis development. Company announcing earnings today include Sinopec, AAC Technologies, Cowell, AIA, Bilibili, Kuaishou, CR Power, China Power, Heng An International, Li Ling, OOLIL, Bank of East Asia, China Fourth Paradigm, Miniso, RoboSense, and Simcere Pharmaceutical. Regarding Sinopec, sources indicate that the Chinese government plans a comprehensive overhaul of the domestic petrochemical and refining industry, phasing out small-scale facilities, upgrading outdated capacity, and directing investments toward advanced materials. These measures, potentially launching next month, await final approval from the Ministry of Industry and Information Technology. The plan aims to address chronic overcapacity in low-value petrochemical segments, proposing upgrades for facilities over 20 years old, about 40% of the total, to boost output and encouraging a shift to specialty chemicals while reducing investments in oversupplied commodity chemicals. New investment policies will prioritize chemicals for AI, robotics, semiconductors, biomedical equipment, batteries, and renewable energy. Small refineries with annual capacity below 2 million tons may face closure. Kuaishou's second quarter results are expected to benefit from growth in advertising and e-commerce revenue, as well as monetization of its Keling AI model, with revenue projected at 34.5 billion yuan, up 11% year-on-year, and non-IFRS adjusted net profit at 5.085 billion yuan, up 8.7%. Investors will focus on management's latest operational and strategic guidance, including plans to expand direct e-commerce, investment budgets, new business ventures like delivery services, and Keling's subscription user expansion plans. In the U.S. stock market influenced by a broad decline in technology stocks, the S&P 500 index fell for the fourth consecutive day, dropping 15 points or 0.2% to close at 6,395. The Nasdaq index also declined for the second straight day, falling 142 points or 0.7% to 21,172. The Dow Jones Industrial Average was the only major index to record a gain, edging up 16 points to close at 44,938. The Nasdaq China Golden Dragon Index, reflecting the performance of Chinese concept stocks, rose 24 points or 0.3% to 7,606. The Trump administration is reportedly considering taking stakes in chip makers receiving funding from the CHIPS Act, leading to a decline in semiconductor stocks. Intel dropped 7%, while AMD and Broadcom each fell about 1%. Nvidia initially declined over 3% but rebounded to close nearly flat. Elon Musk stated that due to the rise of autonomous vehicles in the US market, Tesla's six-seat Model YL may never be produced in the US, contributing to a 1.6% drop in Tesla's stock price. On the earnings front, Target reported better than expected quarterly results, but announced a new CEO, leading to a 6% drop in its share price. For its second fiscal quarter, Target's net profit fell 21% year-on-year to $940 million, with earnings per share at $2.05, surpassing expectations of $2.03. Revenue declined 0.9% year-on-year to $25.2 billion, exceeding estimates of $24.9 billion. The company reaffirmed its lowered full-year guidance from May, projecting a low single-digit percentage decline in sales and adjusted earnings per share of approximately $7 to $9. Home improvement retailer Lowe's reported quarterly profits that exceeded expectations, with its stock rising 0.3%. The Federal Reserve's July meeting minutes released on Wednesday revealed concerns among central bank officials about the labor market and inflation outlook. Though most believe it was premature to cut interest rates, two governors, Christopher Waller and Michelle Bowman, dissented, advocating for an immediate rate cut the first time in over 30 years that multiple governors opposed an interest rate decision simultaneously. Another market focus this week is Federal Reserve Chair Jerome Powell's keynote speech scheduled for Friday morning at the Jackson Hole Symposium in Wyoming, where he is expected to discuss short-term interest rate directions and long-term policy outlooks. Our stock pick today is Tongcheng Travel, stock code 780. Tongcheng Travel announced its second quarter results for 2025. During this period, China's tourism industry maintained strong growth momentum, with increasing demand for experimental travel as younger tourists sought unique, immersive experiences both domestically and internationally. Despite the dynamic market environment, the group leveraged deep user insights and continuously optimized products and services to swiftly seize new opportunities. As a one-stop platform, the group provides comprehensive travel-related products and services. As of June 30, 2025, its online platform offered over 475,000 flight routes operated by more than 770 domestic and international airlines and agents, over 4.1 million hotel and non-standard accommodation options worldwide, approximately 160,000 bus routes, more than 880 ferry routes, and ticket services for over 10,000 tourist attractions. By offering a wide range of travel products and effective user engagement strategies, the group achieved sustained growth in both its user base and user value. In the second quarter, the group's average monthly paying users grew 9.2% year-on-year to 46.4 million. The group reported revenue of 4.669 billion yuan for the second quarter, a 10% increase from the second quarter of 2024. Adjusted EBITDA rose 29.7% to 1.185 billion yuan, with the adjusted EBITDA margin improving from 21.5% in Q2 2024 to 25.4% in Q2 2025. By business segment, accommodation revenue grew 15.2% to 1.371 billion yuan. The group actively tapped into emerging accommodation booking scenarios such as weekend getaways, concerts, and sports events, driving average daily room nights to a record high. Additionally, by focusing on high-value users and expanding in lower-tier cities, the group further increased its market share and competitiveness in these regions. In the international hotel business, efforts were made to deepen partnerships with global suppliers and strengthen operations in popular outbound travel destinations for Chinese tourists. Transportation ticketing services revenue rose 7.9% to 1.881 billion yuan, primarily driven by an enriched supply of value-added products and services. Other business revenue surged 27.5% to 755 million yuan, propelled by strong performance in hotel management services. The group's asset-light hotel management business continued to expand its coverage in China, with over 2,700 hotels in operation under its platform by the end of June 2025, and an additional 1,500 hotels in the pipeline. However, the vacation business was impacted by safety concerns in Southeast Asia, resulting in an 8% revenue decline to 661 million yuan. Looking ahead, the group will continue to focus on its core online travel platform business, striving to enhance market share and brand influence. While consolidating its position in the domestic market, it will vigorously promote outbound travel to boost its international presence and strengthen its hotel management business to increase its influence in the tourism industry chain. The recommended buy price is 21 Hong Kong dollars with a target of $23.2 and a stop loss at $20. I do not hold the aforementioned stock.